To all our viewers, partners, and investors from the GoldenPi community, a very warm welcome to all of you. I'm Abhijit Roy, co-founder and CEO of GoldenPi, India's leading online platform for all your fixed income investments. So today is the 13th episode from our Industry Speak series, and it's very special. For our regular viewers, you know that we invite the industry veterans, the promoters, and the CXOs of financial institutions and get into deep discussions with them to understand about their company and know more if there are investment opportunities. But today we won't be having discussion about a financial company, but on a very special topic, a topic which is of great interest and importance to the entire nation as of this point. It's the interim budget. And who can be a better entity to share perspective and insights on this particular topic than the largest and the most respected credit rating and research company, CRISIL. Ladies and gentlemen, it's my sheer pleasure to invite to our discussion today Mr. Piyush Gupta, who is the director at CRISIL. Just to share a little background about Piyush. So he manages the investment research practice, which caters to mutual funds, insurance PMS, alternate investment funds, and retirement and pension funds. Piyush has been associated with CRISIL for over 19 years and has contributed significantly to building up credit systems, frameworks, which are used by multiple capital market entities like banks, provident funds, AIFs, etc. A very warm welcome to you, Piyush, for a discussion today.
Thank you, Abhijit.
Good. So I think today we are going to have a very specific discussion focused towards the overall budget that was shared by our Honorable Finance Minister, Mrs. Nirmala Sitharaman, in the morning. And we will understand what is the impact of this budget on the investors' investments and portfolio. So with that, let's get started. Well, I'll just take a pause. For our viewers, we will be having a very deep and engaging discussion now with Piyush. During this discussion itself, please feel free to put in your questions. We will have our, this entire discussion for around 45 minutes, after which the rest of the 15 minutes we will use to answer the queries. All right. So, Piyush, here's the thing, right? Today we had the interim budget, and then there is the general budget, right? Or the regular budget. For for a lot of viewers, I think the question would be, what is the difference between these two budgets? Let's start from there today.
Yeah, sure. So, Abhijit, full year budget, of course, maps out the country's economic goals for the full fiscal year. We being in the election year, the budget that was presented today was the interim budget. This is a budget that typically provides the financial information of the economy for a temporal period. It also allows the government to plan and for the government expenditure for this limited period till the time the elections, the new government gets appointed. Other than that, it kind of ensures continuity in governance. Having said that, the interim budget also gives direction and projections of government towards country's economic growth, inflation expectation, and financial borrowing numbers. And each of these factors have a bearing on capital market and thereby has an impact on investors, especially the ones who are investing in capital market through different routes.
Got it. Now, continuing on this specific topic of this macroeconomic moves, right? And the government's declarations in this interim budget. What are your views of this budget? How is it going to shape the capital market and specifically, the debt market of the country?
Right. So one of the key takeaways from today's budget was the fiscal consolidation. The numbers that were put out today, as far as the fiscal deficit was concerned, for the next financial year is 5.1%, which is lower than the 5.8%, which is expected for the current financial year. In fact, the budgeted number for previous financial year for the current financial year was 5.9%. When we look at these numbers in the absolute terms, the fiscal deficit will be 16.85 lakh crores compared to 17.35 lakh crore for the current fiscal year. Further, this will also bring down the gross market borrowing from the government for the next financial year. The gross borrowing for the next financial year is expected to be about 14.13 lakh crore compared to 15.4 lakh crore, which is for the current fiscal year. This also means that the net borrowing is going to be lower compared to the current fiscal year. This lower borrowing will have a downward pressure or a easing pressure as far as the yields are concerned. In fact, as we speak today the 10-year GSEC has eased by 6 to 7 basis points compared to the yesterday's closing number. We also see a lower inflation for the next fiscal year. We expect the inflation to average around 4.5% compared to 5.5% in the current financial year. In addition to that, lower crude oil prices can also be additional factor which will have a downward impact as far as the yields are concerned. So net from the debt market investor perspective, the higher yields that we have experienced in the last couple of years, there at least we see some bit of downward movement as we move into the next financial year. Abhijit, you're on mute, I believe.
Yeah. So, in continuation to the point that you mentioned, right, that the downward movement of the yield curve, right? Two things. One, how do you see that impacting the corporate bond market per se, right? I mean, from the perspective that you mentioned, government has mentioned that the borrowing via the issuance of fresh G6, the dated securities is going to be around 14.13 lakh crores, right? Which is lower than around a lakh crores from the previous year, which was 15.7-ish lakh crores, right? Now with lower borrowings, how do you see that impacting the issuance of the corporate bonds or the debentures in the market by the private players?
Yeah, so that definitely has a positive impact as far as the issuance are concerned. One can expect higher issuances compared to last couple of years. In fact, the issuances in the corporate bond market has been little subdued compared to maybe when we look at numbers prior to 2020 or before COVID. So that is something it does have a positive impact. Having said that, this is not just one factor which has a influence on the borrowing. There are multiple other factors which will play out in terms of the borrowing that the corporates will do, which will eventually have an impact on the issuances that come about in the debt market.
And staying on the same topic, we know that certain of the government securities are due for inclusion into the JP Morgan, Global Bond Index, and this is slated for June 2024, right? Now, isn't that a great opportunity for the government to issue more GSEC and allow the investment of FPI funds over here through the, the far route, or like how does that play around over here? How do you foresee this equation playing around of our GSECs getting included into the global bond indices, and portfolio money coming in into the country, while at the same time government has issued that it will have lower borrowing, so lower issuance of these securities. How do you see this equation panning out?
So in fact, I would say inclusion of the Indian government securities in the global indices is definitely a positive from the perspective of deepening of Indian bond market. It one diversifies the investor base. Uh, it means that there's a inflow that is going to come into Indian debt market through this route. Uh, uh, in addition to the factor that we discussed earlier, this will also kind of contribute in easing of the yields, given that the flows will come in from the global market. Having said that, if you were to look at the total amount outstanding, which is expected to get included, is about 1.65 lakh crore. When you compare this with the expected borrowing of 14 lakh crore, it is still a small share compared to the overall bond issuances that we expect in the next fiscal year. This, at a larger level, is positive from the debt market perspective, but you can have interim volatility whenever there is a rebalancing that happens in these indices. The inclusion of Indian government securities in other bond indices is also expected. That will
In the
also
Bloomberg
bring in some bit
index.
of volatility. Yeah.
Got it. Got it. Just to summarize what you mentioned, that one, this is the great news definitely for our GSECs getting included into the global bond index, and we will see more bond indices into which we should be getting included. So FPI money will come in, but definitely that will have a downward pressure on the yield curve. That would eventually happen, right? And that would also probably have a ripple effect on the corporate bond yield curves as well.
Yeah, just to add one point here, uh, last year when this was announced, for a short period of time, interest rate did go down. There was a easing that we saw after the announcement of inclusion of government securities in these indices. But it's also important to note that after a while, the other factors came in, and we saw interest rates or yields going back to their earlier levels. So this is again one of the factors. There will be other factors which will be at play, which will have an influence in terms of the impact on the overall yield that we see in the Indian market.
Right, right. Now, continuing on the topic of the corporate bonds per se, right? I mean, there were some very special bonds which got a lot of highlight and issuance in the last fiscal year, namely the municipal bonds, the green bonds, and then of course the sovereign gold bond tranches that came in 4 times in the last fiscal year, right? Now, it would be of interest to know, how do you foresee this trend going ahead in this fiscal year, and will the volumes increase significantly, and what are the key things that investors should look out in this particular emerging space?
Right, right. So municipal bonds, in fact, have been there in the Indian market for a very long period of time.
Yes, I
Uh,
believe the first municipal bond was issued by Bangalore municipality. That's what was recorded in RBI. Just a trivia.
yeah. So it's been there for a very long period of time.
Yeah.
Unfortunately, it is a segment which has not grown significantly. Just to draw a parallel, if you look at developed market like US, munis have a fairly material share in the overall bond market, which is there in US. But that's not the case in India. We do This is an important segment. However, this is a segment which continues to remain small from the overall size of the Indian debt market. There are a few challenges, I would say, with respect to municipal bonds. See, from an investor perspective, when an investor wants to make an investment decision, they look for information. adequate information basis which they can make an informed decision, which possibly is at times is a bit of challenge when it comes to municipal bonds which are issued. There are also challenges with respect to the total issuances that have come in the market. Generally, these ticket sizes tend to be smaller. Investor perspective, if the size is not adequate, they don't tend to have a lot of interest given the time and effort that will go into analyzing and then making a decision. So there are few factors which have meant that the municipal bonds per se continue to remain a smaller portion of the overall debt market pie. Green bonds is something that we saw the first issuance happening last year by the government of India. Now, these are newer age securities. If you look at globally, it is about $2.5 trillion worth of total issuances that are there. Having said that, emerging market is still 2% of the total pie. So to that extent, it's still a small portion as far as the developing economies are concerned. And that is true for India also, where we had the issuance coming only in the last 1 year. If you look at green bonds, generally long-term investors like retirement funds and insurance companies, they tend to participate in these bonds. And there is a specific mandate that is there within their overall investment pattern, which allows them to participate and invest into these bonds. In India, if you see, we are yet to see that playing out. Having said that, the yields that are going to be offered by these bonds is going to be critical from a domestic investor perspective. And while this is a segment which is expected to grow, but we have to see how different factors play out. Sovereign gold bond funds, of course, is a unique product, I would say. It's a product which offers interest or a regular income in the form of interest that is available, but it also gives exposure to an asset class like gold, which is a natural diversifier. It gives diversification to the investor. Any investor who wants to diversify their portfolio across asset classes, gold is a good diversifier when it comes to when you compare it with equity or for that matter debt. That has also meant that the subscription in these bonds have seen a continuous increase over the last 5 years. For example, I think in 2016, the total subscription was about 1,300 crores, while in the last couple of years, the subscription has been about 16,000 crore and 12,000 crore. So to that extent, there is an interest, investor interest, which is there in these bonds. And this is also to some extent the Indian investor who have a liking for gold, which is generally a large part of their investor portfolio. This becomes a good option for investors to participate. It also has other benefits in terms of this being a non-physical form of investment. So some of the challenges which are associated with physical gold investing, those are overcome with these bonds.
So if we may double click, on each of these three asset classes, the money bonds or the municipal bonds, and then the green bonds, and then the sovereign gold bonds one by one. So, on the municipal bonds, I think the last tranche that came was in the form of an NCD IPO sometime back. Indore municipality that issued the, Indore municipal bonds, right? And definitely there was a portion earmarked for retail and it got subscribed, right? Seemed like a fair amount of response from investors. The question over here is, these are great sources of funding for the municipalities to develop their entire infrastructure, right? And US has been able to use it very successfully. As you mentioned, it's a multi-trillion-dollar market for the money bonds over there, right? And has great amount of depth and liquidity. The question is, what can our government do to facilitate the widening and deepening of this specific, bond type in the Indian capital market?
I think some of the challenges that I spoke about earlier, they have to be overcome. So information asymmetry or transparency is a critical factor. Any investor who is looking at investing into these bonds, for them to make an informed decision, the the information has to be clearly available. Second is, I think one of the factor that also and discuss is the accounting practices that are followed by municipal corporation may not are not in line with the what the investors look at. You typically have a case where the municipalities follow a cash-based accounting, which is possibly not the best way of accounting finances. So some of these challenges have to be addressed. Uh, and of course, financial strength or the rating of these instruments becomes a key component. If you look at the rating of these bonds, I think the highest is about AA and there and thereabout. When you look at some of the investors, especially the pension funds or insurance companies, their preference would tend to be more on AAA and AA plus. So that again is a factor when it comes to investing into debt or bonds. Uh, so some of these factors will have to be looked at when it comes to sort of looking at. So these factors will play out as far as the growth of monies are concerned.
Got it. So just to summarize what I understand from from what you mentioned, one is greater amount of transparency, greater amount of information dissemination amongst investors, and better accounting practices possibly, which gives more fairness to the overall financials of theirs, right? That would become very important in developing the money bonds in our country.
And also one more factor is the funds which are raised, they also need to be deployed in an efficient manner so that there is the sufficient revenue which gets generated, which can be used for servicing these bonds.
Right.
So efficient utilization of fund also becomes critical from investors' perspective.
Yeah, and once they start doing it, even if they're able to showcase it, rating agencies like yours, right, would be able to give them a better rating, and then it means they will become, suitable candidates for investment by these pension funds, right? So definitely, I mean, there's a lot of work to be done on that ground. But yeah, it's a market that we hope that grows up and is able to fund the municipalities across the country for the entire country's growth. Now, double clicking on this green bond side, right? You mentioned that pension funds and other alternate investment funds have got provisions to take some exposure into them, right? And the first tranche we saw was last year, right? The question over here is, in this new segment, is there a way for retail to also participate, or does it have to be through a fund route? Like, I mean, can I invest in a green bond, a bond only, right, as asset class, like I would do in, let's say, a corporate bond of a particular company or a bank, right? Do I have that provision for green bonds also?
So I think the bonds which were issued last year, I think to a large extent, so most of these bonds were subscribed by the global investors. So basically, it's the foreign money coming into
Understood.
India through these bonds. So I think not sure. I won't be able to comment on whether the retail investors can participate at this stage. But and if you look at it, largely it is a segment which is being preferred by foreign institutional investors, where there is a mandate, a part of their mandate allows them to invest into such papers. If you look at India, you have uh, so green bond is one aspect. You have new ESG mutual funds also, but largely those are equity oriented funds. You don't have any debt fund which focuses on themes like ESG or for that matter climate or the green bond that we talk about. So at this stage, even the indirect route is not available for the investors to participate in these bonds.
Got it. Got it. Now coming to the topic of the sovereign gold bonds, right? There is an increasing appetite that we see of participation by retail over here also, and I think there's a tranche in February which is being, which will be opened up by RBI, and uh, retail investors can buy as low as 1 unit of gold over there. They get 2.5% that extra income that you mentioned, right? Which is paid half yearly. And then there's capital appreciation, capital gains tax exemption, all great story for retail, right? But then if I extrapolate this to the overall corporate bond market also, right? We know there are some very great moves which has been done by SEBI lately in bringing down the privately placed bonds face value from 10 lakh, which erstwhile, to now at 1 lakh. And then there are, white papers on discussions of bringing it down even further, right? And also mechanisms that online platforms offering these bonds need to be registered as a debt broker and need
Yes.
to be a member of the exchange, any one or both of the exchanges, as an OBPP member or an online bond platform provider. Uh, Now, are there other things beyond this also that the government can do to increase the retail participation into this bond market? What would be your views, as a specialist in this field?
Yeah, so in fact, some of the initiatives that the government has taken, including regulator, has definitely meant increased participation in the bonds in the last 2 to 3 years. In fact, if I look at some of the numbers, the RBI direct platform has seen an increased number of participation by 62% in the last 1 year. Even in case of online bond platform like yours and many others, there's a increased participation that we have seen, 100% increase in the last 3 years, which
Yeah,
has meant that this is an area that investors are finding it useful from the perspective of portfolio building. Uh, I think you spoke about decrease in uh, the ticket size to 1 lakh rupee. But when you compare this number to other investment options, the ticket sizes are far lesser, right?
right.
Including small saving schemes or fixed deposit, or
Ab-
even for that matter, mutual funds. The
Absolutely.
ticket size for a retail investor is far lower compared to the 1 lakh rupee that we have here.
Right.
So that is a big factor, and that can further enhance participation. Having said that, investor experience is critical when they invest into these bonds. Uh, uh, and this is what we have seen even in case of mutual funds. When investors experience fairly good performance as far as the equity funds are concerned, there seems to be a continuous flow of money that has been coming into a mutual fund. Similar will be true for even participation of retail investor into direct bonds through the online platform. Of course, ease of transaction becomes very critical. How easily the investor can start investing into these bonds also becomes a big factor. If there are operational challenges, then investors who are willing to evaluate these options would sort of you lose those investors possibly for a period of
Right.
time. So these are some of the areas I think would be critical for increased participation.
So just to summarize, what you mentioned is one, further lowering of the ticket size to really, really retail sachet, which is not there as yet, but which is there prevalent in the other investment assets. Number one. Number two is, quality of the inventory that is coming out into the market. And number three, the investment experience of the retail investors. It needs to be very seamless so that, they have that ease of transaction and they can stick on to this particular asset class with great investment experience and post that also. Great point. Now, a special category of these bonds, in the corporate bond area, is the capital gains taxation saving bonds, the 54 EC category, right? Now, it is capped at 50 lakh for an investor, right, in a fiscal, and the government hasn't changed that, right? What do you think will be the impact of this one, on investors, on this particular area of, of trying to save the taxes post their selling of these assets?
Yeah, so again, it's a 54 EC bonds are a good avenue whenever an investor is sort of exiting immovable property and booking or redeeming those investments, if they want to kind of look at saving capital gains from those investments, 54 EC is a good avenue. Having said that, there is a cap of 50 lakh rupees. So to that extent, there is a cap that is in place for investors to take benefit as far as the capital gains are concerned. And if you look at the immovable property, the prices can be much higher compared to the 50 lakh, which is currently there. So the increase in the cap will definitely improve the appetite. These are the bonds which are typically issued by AAA rated issuers like NHAI, REC, PFC. So which are from the perspective of safety, uh, these are highest rated bonds.
Yeah.
So which is a good avenue for someone to transfer funds once he has booked returns from the immovable property that we have. So these are good investment options, but of course the cap sort of keeps the limited participation. And of course, the supply or issuance of such bonds by these entities is also another factor from the perspective of investors participating into these bonds.
Got it. And also, the investment over here, I think, is largely paper driven. It's still not yet digitized, mostly not yet digitized. So that's also a challenge, maybe, that's an area of improvement that can work out. Uh, Now, I'm tempted at this juncture to ask a bit of a controversial question, right? So, I know, CRISIL, you specialize in providing investment research to the capital market, right? Including mutual funds. And the topic that I am tempted to ask is last year, the government has removed the indexation benefit on debt mutual funds, right? So now for an investor, the corporate bond taxation and the debt mutual fund taxation are exactly the same, right? There is no benefit here or there. And corporate bonds in general yield more than debt mutual funds, if I may say, right? Now, given this scenario, do you still think that debt mutual funds are an attractive destination or will be an attractive destination for retail investors to invest into?
Yeah, so I think these two options are still available to the investor and investors. I think one of the key differentiation between mutual fund, debt mutual funds, and direct bond was the indexation or the tax benefit, which
Yeah.
was available earlier, which has been done away with. So to that extent, the both products now come on par. And from investor perspective, now for them to make a decision, it is looking at the risk adjusted return from both the investment options that are available to them and make a choice. Having said that, couple of points possibly when you look at mutual fund investments, debt investments, uh, the liquidity is one factor which is still available with a debt mutual fund, which possibly with a direct investment at times could be a challenge. And it also the typical benefits of mutual fund investing in terms of professional management and diversification continue to remain in addition to liquidity. So these three factors are still there. Having said that, with the tax realization that happened last year, to prove products have to be compared strictly on the basis of performance, and the one which provides better performance, the investors can always choose.
Got it. Got it. So yeah, I mean, for our investors, right? I mean, whenever you make an investment, take a judgment call on all parameters, right? That would be there across both these asset classes. Now, moving on to the next question over here. REITs and InvITs have been instruments of the capital market for some time now, and uh, they haven't really seen much of a growth. But then the question is, in this fiscal year, are you seeing further growth on this area or certain changes, that would come into these specific investment vehicles?
Yeah, so REITs and InvIT, these are new instrument types. These are fairly popular globally, but we haven't seen the growth uh, in India as much as one would expect. Again, these are hybrid instruments. These they have a bit of equity component, given that and to that extent, the volatility that is associated with these instruments.
So,
Uh,
Piyush, I'll just pause you for a minute, for a benefit of a lot of our viewers who might have not yet got the exposure into REITs and InvITs, right? If you could explain simplistically what a REIT means and what an InvIT means, I think that would be beneficial. And then, you can share your perspective on how this market is poised for growth and what the government can do around it.
Yeah. So REITs and InvITs again, these are trust structures. So similar to a mutual fund where there is an underlying portfolio, REITs and InvITs are again structures where there is an underlying portfolio. The only difference is in case of REITs, the underlying portfolio comprises of real estate assets, and in case of InvITs, it is essentially the infrastructure assets. Again, infrastructure assets can vary from road assets to transmission lines to various infrastructure, uh, energy assets, and so on and so forth. Uh, these You have a team, so the money is collected from the investor. There is a fund management team which manages that money, deploys that money into different assets, which are basically a carve out from or the from the existing assets. They are pulled together and where the money is deployed and which are used to kind of purchase these assets. Now, if I were to look at InvIT as an option, it's a instrument where once the money is deployed, the income that is generated from the underlying assets, 90% of that income has to be distributed to the investors on an annual basis. So that's one requirement as far as the SEBI is concerned, which means that these are regular income generating instruments. So any investor who's looking for regular income, these are the instruments that one can look at, which
And
is
what is the minimum ticket size for these usually?
so this is again an instrument where the ticket size has been brought down significantly uh, in the last, I think in the last couple of years. SEBI did make change in the ticket size, which meant that the retail investors can now participate in these instruments. Earlier, the ticket size was large, which meant that there was a bit of entry barrier for retail investors to participate in this. This has come down significantly in the last 1 year or so. Also, the while there is a regular income that I was talking about from these instruments, the prices of these underlying of these InvITs or REITs can vary depending on the performance of underlying assets. So which means that there is that bit of market volatility associated with these instruments. Even if you look at the performance of various InvITs which are listed on exchanges, you do find varying performances. So there are some InvITs who have delivered positive return, double-digit return since the listing on the stock exchange, but there are some where the returns are negative also. Having said that, so anyone who's looking for a regular income, one can look at this. And also investors need to keep in mind these are not debt instruments. These are hybrid with a equity component in it. Uh, Essentially, it is a high dividend yielding paying equity that is there with these instruments.
And do they come with a tenure, or is it like one has to exit like in a mutual fund?
No, so these are not tenured. So to that extent, this is an equity instrument. It's something which is listed on exchange. The underlying assets, the value of those assets reflect the prices of these instruments on the exchange, and there is no maturity to these instruments.
Got it. Got it. Now, and you mentioned that, they're gradually growing, sectors of financial assets, not yet very large in the country. And I think we have got four REITs in the country,
Yeah.
Embassy REIT and being one of them, and a few
Yes.
others. I think total four that are there, right? So pretty small space. The question is, what do you think can the government do, positive steps over here to increase this particular, the financial assets market size?
So I think, like we discussed the ticket size has already been decreased for these assets. So to that
That's one
extent, the
change. Yeah.
barrier is been removed. Uh, I think it's more about creating awareness about these instruments. What purpose do they serve is something that the investors need to understand. And see, it's also about ability of an investor to evaluate these instruments. Uh,
Hmm.
uh, Whether they can make a choice between whether this is good or this is not so great in terms of
Hmm.
performance.
Hmm.
So those are some of the areas I think that investors will look at when they make a decision. Of course, the investor experience in terms of performance also, like we discussed earlier, is a relevant factor. So I think these are fairly regulated instrument. SEBI has brought in a lot of regulations around this. They have requirement of limiting the leverage of these instruments in the so to that extent the overall leverage in these instruments are less. So I think the instruments are good, but the performance is something that remains to be seen. The underlying assets, the performance can vary. For example, rose asset, there are different like kind of risk associated with rose assets, which are part of the InvITs. Uh, so they that will have a kind of a that has an impact on the overall performance of these instruments, and investors need to understand, and then they can take a call on investing into these instruments.
And just a very naive question, like do these REITs and InvITs underlying need to be, commercial estates which generate capital? Otherwise, like, I mean, how would you distribute the dividend, right? I mean, very naive question. If you could
So
clarify.
revenue generating instrument. So I think the 80% of when you look at InvITs, I think about 80% of the assets need to be operational, which is the reason why. So that's again one of the factor that uh, regulator has mandated as far as the InvITs are concerned. So there are a number of requirements that are put in place for REITs and InvITs from the investor perspective, which are positive.
Got it. Got it. Um, so, we got some good understanding about the REITs and InvITs. For our viewers, these are definitely high yielding, hybrid asset class, more on the equity side, very little on the debt side, right? It would be dividend paying assets, right? And one needs to evaluate them, the underlying assets that they encompass, and make a judgmental call. They were meant specifically for large ticket investors before, but government has made some proactive changes by virtue of which now retail investors can also look to participate in these issuances with some lump sum amount of money, right? So it's a great way to generate cash flows as well, right? However, it depends upon the performance of the underlying assets, as Piyush mentioned, right? Now, one interesting thing, and I think that would be of interest to everybody over here, is that there was an expectation the government could increase the standard deduction from both the tax regimes that we have, right? But there wasn't any change in that, right? Um, Now, how would that impact, the investor sentiment in the country?
Yeah, so I think tax slabs or changes in tax slabs or bringing in expectation of having more tax incentives is always a expectation that you have every year before the budget.
Yeah, right.
So, but if you look at that's one of the, and at times, a lot of time investors kind of uh, pivot around tax benefits when it comes to making the investment decision. But possibly that's not the right way. If you ask me, I think the investment decisions are to be taken independent. Of course, tax is one factor, but there are a lot of other factors that play out when it comes to making an investment decision. Uh, Tax benefits do bring in that positive impact with respect to investors coming in and deploying more money. They tend to kind of utilize whatever limits are available, be it ATC or ATCCD. Different
Hmm.
provisions are there. Uh, uh, But if you look at, I'll give an example of, again, say mutual fund, right? So you have ELSs as a category. But if you look at the overall equity assets, it's still a fairly large number compared to ELSs. Of course, the cap in terms of benefit also limits the participation in ELSs as a category. Having said that, even though the benefits like ATC is not available across equity mutual fund categories, there has been a fairly good participation that we have seen over the years. So as long as the performance is there, you are able to generate the returns which are expected as per your expectation. Tax would be one of the factor that will bring in that additional kicker. But from the perspective of financial planning or personal finance planning, uh, I think the investment horizon, what is the sort of goals that you have, play a critical role when it comes to building a portfolio.
Right, right. One last question, before we conclude our discussion and move on to taking the questions that have been posted by our viewers, right? So, if I have to ask you to define today's interim budget in one sentence, right? What would be your expression for it?
Right. So I see, as I said, this was an interim budget. So I think a lot of announcements that will eventually come in the full year budget that will come in after the general election. I think one of the key factor that we discussed earlier was the fiscal consolidation. That is very positive from the perspective of the overall economy health, and also from the debt investors who are already invested into debt invest instruments, where with the easing of yield, that will have a positive impact on the returns from a capital appreciation perspective. So yeah, that's about it. So it's end of the day, it was an interim budget. So we should look at the final budget that comes after the general election.
Got it, got it. And I follow a standard, sort of practice in these discussions, that whenever any term is used for the sake of our viewers, right, I request, the guest to actually explain. You use the term fiscal consolidation. If you could lay out what that means for our viewers.
Yeah, so I think government has laid down a plan whereby the fiscal deficit, they have a target to reduce it to a certain level. That's what finance minister mentioned during the budget. Uh, so that's a plan that they intend to follow over the next 2 years. Bringing down the fiscal deficit to an acceptable level is what the fiscal consolidation is all about.
Got it, got it. Now, with that, I would move on to the questions that have been posted from our from our viewers. So let's take the first question over here. The first question is this is from an anonymous attendee. Name is not there, but I'll put forth the question. It's an interesting one. The total size of the 2024-25 budget stands at rupees 47.66 lakh crore, 6.1% bigger than the revised estimate for 2023-24. To help meet the gap between its income and expenditure of rupees 16.8 lakh crore, or the fiscal deficit pegged at lower than expected 5.1% of the GDP, the center will borrow 14.13 lakh crores from the market by issuing bonds. Okay. How do you see this impacting the bond yields or the GSEC yields? I think Piyush has covered it. Nonetheless, maybe Piyush, you can re-emphasize on this question.
Yeah, so I think what we have seen is the fiscal deficit is something which is pegged lower compared to the current financial year. We do expect lower inflation in the next year, along with the declining crude oil prices. So all of these factors will kind of contribute towards easing of yields as we move in the next fiscal year. On top of it, inclusion of Indian government securities in the global indices will further add to the easing of interest rates. So at least what we believe is by the end of this year, the 10-year GSEC will be about 7%. And in the next 1 year, it should come down to 6.8%. That's the expectation that we have as of today. Of course, the markets are dynamic, so you will have a lot of other factors playing out. But with the current budget, today's budget that we saw, at least the immediate impact is the downward pressure on the yields that we have seen. Even today, the 10-year GSEC is reached by 7 basis point. So that's the impact that we have observed.
Okay. The next question is from Satyavir Singh. This is a question which has been answered, during the discussion. Nonetheless, I'll bring it up for the benefit of all. Was there a change in the taxation as it was anticipated for this budget? No. Also, how do you see the growth of the nation as a whole with this budget? A generic question, but Piyush, you may kindly share your views.
Yeah, so I think there's a lot of initiatives which anyway beyond the budget the government is taking from the perspective of GDP growth, and we have seen higher than expected GDP growth even for the current fiscal year. So that's something that we hope will continue as we move into the next year. There are one is the set of announcements that are made in the budget, but beyond the budget, there are also a lot of initiatives that are taken by the government. Of course, we have to see the full fiscal year budget when it comes around after the general election. That will also show a clear picture in terms of how the entire year will look like from the perspective of economy.
Got it. Our next question is on the infrastructure development. And the question is, in this interim budget outlay for infrastructure development was lot in focus, say 11.11 lakh crores for FY25. Can we see an increase in bond issuances in this segment? Interesting question.
Yeah, so we can see, I think we'll have to see how it plays out. Infrastructure spending, the borrowing can happen either through bond or there are alternate means to raise money. So it's how the funds will be raised, and eventually that will determine the total borrowing that will come in. Again, one of the factor would be also the reduced interest rate. So that will have a positive impact on the increased borrowing through the bond market. So we can expect an increase in that.
So overall, it would be a positive time for the bond market that we can think of. Cool. I think that's all. To our panelists, to our viewers, if you have got further questions, feel free to write to us, and we'll share with Piyush and the CRISIL team so that they can share their answers, their perspectives, and we'll get back to you with that, right? So Piyush, thank you so much for your time and sharing those deep insights, right? You are an industry veteran, right? Fully armed with the knowledge about this capital market, right? And the views that you have shared will be invaluable to our investors and our viewers alike. Thanks a lot for sharing that with us.
Thank you so much for having me here. It was indeed pleasure talking to you.
Likewise, Piyush. Thank you, everybody. A big round of thanks for all our viewers today. Hope you learned a lot from this webinar and about the interim budget, and we'll wait to see how the final general budget shapes up.
Thank you.
Thank you.
Investments in debt securities are subject to risks. Read all the offer-related documents carefully.